India's investment landscape is changing fast. From gold and land to equities, mutual funds, and even digital assets, Indian investors are exploring it all. But while opportunities have multiplied, so has the confusion. Many investors now build their portfolios the way they would pick dishes at a buffet, a little of this, a little of that, often based on what's trending, on what's someone's recommendation. And that's exactly where things can go wrong. An impulsive, unbalanced approach can do more harm than good. Enter Ionic Wealth, part of the Angel One group, which aims to change how India looks at wealth management by making it inclusive, tech-driven and accessible, not just for the ultra-rich, but for the growing class of affluent investors across India. Let's decode this changing landscape and how to build a balanced, disciplined, diversified portfolio. We are joined by Shobhit Mathur, co-founder of Ionic Wealth. Shobhit, hi. Welcome to the Money Show. And let's talk about the Indian investor base. Clearly we are looking at an involved investor base, from traditional assets to equities, mutual funds, even international markets. How can a wealth management agency like yours become the next big change? How significant is this shift, and are Indian investors actually ready for this transition or this new change?
Thank you so much. And I think it's a very valid question. We are at that stage where I think India is seeing multiplier effect of new HNIs getting created and existing HNIs looking to grow their wealth in a very serious manner. And it is a serious matter because money is serious and it is important for one to give it enough time, attention. But unfortunately, majority of our HNIs and ultra HNI clients do find time as the most critical reason that they are not able to spend enough attention to their portfolio. And that's where I think the job of a wealth manager really comes in, where he's like a kind of a companion. He's like that jamming mate. He's like that partner to your portfolio who's really wanting to come and help you grow your portfolio basis the broad dimensions or the contours that you define for your portfolio. So everything is driven keeping in mind the wealth that you have worked hard to create, keeping in mind what is the objective that you see for yourself and your family for that wealth to do, what's really the purpose behind how you want to grow and what kind of risk you want to take. And I think as a wealth manager, one is able to bring a ringside view, basis experience, basis expertise, and all of us have a very strong team of research folks, investment folks, and technology to try to help us bring to you a very unbiased view of what kind of investment opportunities lay ahead, how does it suit your investment portfolio, and what is it that you should pick and choose between investment options, all the pros and cons of every investment, and then just help you navigate that over years. Because as we all know, markets are a very dynamic investment category. Things change very, very fast. So you need to be really on top of how things are changing. And that's where I think the role of a true wealth manager as a co-founder in your wealth creation journey really comes through.
But then, Shobhit, let's dive deeper into the role of a wealth manager. I just want to understand how really a wealth manager can reduce your risk and improve your returns, and how can investors really trust them with their money?
So it all comes down to bare bones basics and research. If I were to take you back, let's assume a year or so back, Indian equity markets were really at a high, and markets were really giving people a lot of confidence that things will continue to be, going strong. But I think from our perspective as a wealth manager, when we looked at the situation, we really found that there was a lot of value available on the table for investing outside India. And it's a point which played to the tick mark of being diversified, helping you manage your investment across multiple asset classes, but also ensuring that you are getting into new investment categories which are not as richly valued as possibly the Indian market looked like last year. And here came the recommendation to look at markets like US and other emerging markets, which could actually give you enough and more buffer to diversify your portfolio, but also look at new investment opportunities. Similarly, I think the last year has also been a year where we have made strong recommendations to look at investment classes like gold and silver, backed on our own strong research. And again, playing to the thought process of adding more discipline and diversifying your portfolio. And I think if I look back in hindsight over the last year and a half, some of those calls have significantly benefited our clients and their portfolios in ensuring that even when one particular type of investment allocation in your portfolio did not do well, your overall portfolio return still ended up playing a good part. Over longer periods of time, and if I were to broaden the definition of how a wealth manager has helped navigate people, I think lots of time biases play a big role in investment decision making. I think wealth managers, with their experience, with their interactions with multiple other clients, can bring in that little bit of unbiased and more reasoned, recommendation on your table without specifically being, biased towards any particular asset class or any particular fund house or any particular scheme. So it almost becomes like that consultant or that advisor who's helping you grow your portfolio with reasonableness and accountability to what your portfolio mandate is.
I just want to focus on investor mindset and investor behavior, and especially talking about emerging areas like tier 2 and tier 3. How is this new emerging investor base ready and equipped for professional wealth management services? What is so, in terms of readiness, how do you see them?
So first of all, I should put out some numbers for the viewers. I think India already has what I call as a triple multiplier effect. India already has got close to about, if I'm not wrong, around 8 odd lakh individuals who are possibly dollar millionaires, so to say, who have their current assets which are growing at anywhere between, let's say, 10%, 12%, whatever the portfolio returns, depending on their risk appetite, it will give. Secondly, I think there are new set of investors, and if you look at income tax data or you look at any other data in terms of new folios on mutual funds or new uh, you know uh, people who are coming in the tax brackets above a certain threshold, there is a clear category of new investors who are coming into that category of new investors having a large portfolio and looking to significantly grow their wealth. And of course, each of these individuals save some part of their money by way of savings, rentals, dividends, any of those cash flows, which also adds to their existing portfolio. So if you combine all three, I think you're cumulatively talking about anywhere between 25 to 30% growth rate of that industry. And that's where it becomes interesting, because it's no longer limited to the top metros that are there across the country. It is now spreading across multiple different towns and cities. And I think every wealth management firm out there has to now think of a plan to cater to this wider base of potential customers who are going to be there across most of the cities across the length and breadth of the country. And I think that's the real fascination, that's the real deal which I think will propel the growth for India over the next decade or two.
But at the same time, if you look at investor mindsets, Shobit, many investors chase high returns but lack consistency and discipline. So, what matters more, returns or discipline? And how would you like to explain this via data?
So I think it's very, very clear. Discipline is, I think, the most important bedrock of any portfolio to generate consistent returns. I think if one were to really look at it, a good asset allocation portfolio has the potential to significantly reduce your risk by simply diversifying and ensuring that your portfolio gets reallocated to asset classes as asset classes go through their ups and downs. And to give you a simple example, if you were to start with a portfolio, let's assume very simplistically, of 50 equity and 50 non-equity investments, and equity I'm treating as the high risk category and the remaining as the as the low risk category, at different points of time, as markets do well, that 50 equity allocation can potentially become 60. And at that point of time, a pure discipline portfolio will tell you that since your risk appetite allowed you to be 50 in equity, you should make that 60 go back to 50, which means as markets go up, you will automatically book profits and bring your 60 equity down to 50. And now think of the opposite situation where, let's assume, markets were to go down and your 50 equity allocation, because market went down, became 40. At that point of time, rather than thinking and being concerned that equity markets are not making me returns, you would automatically want to increase equity allocation back to 50 because that's what your risk appetite says. You will automatically be buying as lows. So it's a very simple vanilla discipline where if you buy low and you sell high, you will make money. And I think that's what markets can do. And if I look back at our own data, I think we have practically seen a reduction in our overall risk by approximately about 13%. And I think we have seen our returns go up by about 200 basis points over the last many decades of having seen a disciplined asset allocation strategy play out.
All right, I think that will be all. Thank you so much for taking time out today, Shobit, and explaining our viewers every aspect of right decision making towards their investment portfolio. Thank you so much for being on the show.
रिस्क प्रोफाइलर के हिसाब से मुझे